Good morning, I'm Ryan Lehman, and this is Markets in a Minute for the week of February 17th. Equity markets continue to be volatile last week, although it was a bit more subdued than the prior few weeks. We continued to see worries over AI spending plans by mega cap tech names, as well as newfound concerns that AI implementation may actually disrupt certain sectors of the economy rather than actually support them. The sectors most impacted thus far have been software providers, which we discussed last week, and now financial services firms. As a result, we've seen a good deal of selling in tech names over the last few weeks, with the Mag 7 now squarely in correction territory, while shares for names like Amazon and Microsoft are both in technical bear market, both down more than 30% from their all-time highs. From an economic perspective, we did get a good deal of key data points last week, which told somewhat of a conflicting story. The delayed jobs report was actually much stronger than expected, showing strong gains in the private sector. However, at the same time, we saw massive revisions to 2024 and 2025 figures. For 2024, the BLS revised away roughly 500,000 jobs, leaving the total figure at 1.5 million. And then for 2025, the new revision showed that we created just 181,000 new jobs. This equates to just 15,000 jobs per month and was the worst non-recession year for job creation in more than 20 years. Now, switching gears to inflation, on Friday, we received the January CPI report, which did show a cooling in the headline number. On a year-over-year basis, prices rose just 2.4%, which was 10 basis points lower than expectations. Softening energy and housing costs were really the key contributors here. The shelter index showed a year-over-year increase of 3%, which is one of its lowest readings since 2021 and is now generally in line with what we saw prior to the COVID-19 pandemic. Now, combine the disappointing jobs revisions and that soft inflation report, and we did see an impact on rates markets and Fed expectations. On the bond front, we saw rates decline across the curve. Most notably, 10 and 30-year Treasury yields both fell by roughly 15 basis points. We also saw the 2-year yield decline to just 3.4%, its lowest level in our current cycle. This spilled over into Fed expectations, with 2026's first cut now priced in for June with a more than 80% probability. But even more meaningful is the expected 2026 total, which has moved up to 2.5 cuts by year end. So looking ahead to this week, it's going to be shortened by Monday's holiday. However, there are some key economic reports to monitor. In particular, here within the US, we'll get PCE on Friday, as well as some CPI data out of Europe and Japan midweek. On the earnings front, it is going to be generally light. However, we are going to get reports from Walmart and Alibaba. And with that, I want to thank you for watching Markets in a Minute. Don't forget to like, share, and subscribe to get notifications of our future video content. I hope you have a great week.